Ah, yes. Timing the market. Like, imagine if you just knew in every financial market, like, this is the bottom, I've been waiting for this, it's safe to buy, I'm gonna buy now. Like, imagine if it was that easy. I'm that Agent Kelly. I talk about real estate investing, Vancouver, mindset, business, all of that stuff. If you get any value or entertainment from this video, all I ask is that you thumbs up and subscribe. Let's get into the video. There have been many studies done that time in the market beats timing the market, and that timing the market is historically a very low probability way to invest for success. But let's entertain this. Let's entertain the idea that you can actually do this. When do you buy? How do you know that it's the bottom? How do you know that it's a safe time to jump back into the market? Because I always hear, and it's a little bit of a different variation of something like this: I'll buy once prices go lower. Well, I remember back when detached homes in Abbotsford were 1.25 million, and everybody was saying if they ever come back down to $1 million, I will buy. Now those homes are 850 grand, but the narrative has shifted to real estate is going to be down 25% by the end of the year, and these $850,000 homes will be $650,000 to $700,000, and nobody wants to touch these homes with a 200-foot pole now. So how does this even happen? How is this possible that detached homes are down $400,000 and nobody wants to buy? It's because of the changing narrative. It's the same reason why 90% of people lose money in the stock market. They buy into whatever the current narrative is, whether it be asset prices are going to rise for the foreseeable future, or asset prices are going to fall for the foreseeable future and never come back again. They buy into whatever that current narrative is, and this is exactly why people buy high and end up selling low. So let's apply this to real estate. 7 months ago, when detached homes were $1.25 million, there was 50 people fighting over them, writing offers subject free, ready to buy on a dime, cash offer, deposit in hand. Fast forward to today, these homes are 850 grand and nobody wants to buy. But the sentiment now, after homes have already come down $400,000, is that they are going to substantially keep going down. So people think it is unsafe to buy at these prices, right? But when is it ever safe? It's only perceived to be safe once the narrative is that prices are going to go up for the foreseeable future. But if we're talking about risk, the amount of risk you're being exposed to, that's actually a much riskier time to buy, a much more unsafe time to buy than when prices have already come down $400,000. And I'm not even going to talk about interest rates in this video and what it does to affordability and all of that stuff, but this is an example that I have for you guys for something to throw into the equation. Like, not even just talking about prices. There's so many variables that go into real estate, which makes it very difficult to time. It's not as easy as just looking at a chart and doing some technical analysis like a day trader would. But this is an example, okay? I have a buyer looking for a 2-bedroom condo in Langley. We've been looking since about the end of June. Since then, interest rates are up 1.75%, and Langley condos are down 14 grand. So the payment for that condo has gone up like $600. You're paying way more interest, yet the condo itself has only come down $14,000. Now, of course, the condo could continue to keep going down, but currently right now, the better move would have been to buy before the interest rate hike. That could change in the future and likely will go down a little bit more, who knows? But currently, looking at this at face value, it would have been better to buy before that rate hike was implemented. And you just don't know these things. You don't know what the landscape of the market's going to be like if detached homes hit $700,000. We have no idea. What if rates are 8% by the time that happens, right? So my advice to you, that if you are going to time the market, that you pick a strike price. If you're saying, hey, detached homes, 700 grand, I'm buying, You better stick to that plan if 700 grand actually comes to fruition. No, well, I think it's gonna go lower, I'll wait a bit more. If 700 grand is the strike price, you are striking at that price. Because you are essentially what you're doing. This is what day traders and swing traders do. They have a plan before the price action actually starts happening, and then they execute the plan if what they thought would happen actually happens. By waiting for real estate to come down, you are essentially short the real estate market. You are a trader, believe it or not. So if you are going to act like a trader, then you might as well use the same principles that they use to become successful and have a strike price and actually strike on that price if and when it happens. But please understand, when that house does come to 700K, the narrative is not going to be, this is the bottom, you are safe to buy. None of that is going to happen. By the time it hits 700K, the narrative will be, this house is going to $500,000 and you're an idiot if you buy it. And you will have to go against the grain to make that purchase. But my honest advice would be to not time the market at all and just have a long-term time horizon in every investment you make. Don't buy assets that you do not want to hold once the price goes down. If you do that, you are not an investor. You are a gambler. Markets go up and down. If you believe in the product, you cannot be dumping it the second the price goes down. So when you're buying real estate, you need to run the numbers today. What's my cash flow position? What's my mortgage? If I lose my job and have to go get another job, can I still pay this mortgage? Literally think of every single scenario. And if you can stomach the worst case scenario and survive it, and the price is substantially down today and it's affordable and the risk is much less than what it would have been 8 months ago, then buy it. But go into the purchase calculating all of these risks and if you can survive them. If you cannot survive the worst case scenario, then that's almost gambling, right? If that worst case scenario happens, you're gonna be hooped. So I plan for these things. Have a plan A and a plan B. Plan for everything. Plan for the worst case scenario and hope for the best. Go into investments expecting the worst and hoping for the best. And then hold for 8 to 10 years. Real estate is an 8 to 10 year hold. I think the last couple of years have really skewed people's ideas of what it means to hold real estate. In the last 6 years, we've just seen it rocket and rocket and rocket. Like, that wasn't normal. You know what I mean? This isn't normal. Real estate is supposed to be a 3 to 5% year return year over year, not 15, 20%, right? So you're buying real estate, you're in it for the long haul, and you're collecting that rent every month and paying down the mortgage. But back to timing the market. It is historically a terrible low probability plan that has burned millions of people over the last 40 years in Vancouver real estate. And maybe you will be the one-off. There's probably 1 in 100 people that are successful in timing the market here in Vancouver, and maybe, just maybe, you'll be that 1%. But please understand that the probability is heavily against you, right? It's like betting for the Chicago Bulls to win the NBA Finals this year. It could happen, and the payout is massive. But the probability is very low, and it's not a bet that I'm going to continue to make over the course of my lifetime. Just think about how many people have been priced out of Vancouver real estate in comparison to the amount of people that have made money timing the market here. So anyways, that's my take on timing the market in Vancouver. If you enjoyed this video, please thumbs up and subscribe. We'll see you on the next one.